Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, December 21st, 2018. As always, please hit the like button on this video and subscribe to this channel. So we have quite a bit to cover, lots of bearishness, bears take control, the stocks are approaching what I think is initial downside targets, and I'll explain what this W pattern means. We're probably gonna see a bounce after this downside leg takes place and the bottoming pattern unfolds. And I'll show some upside targets once this bottoming pattern unfolds, as if it unfolded today. So generals are fleeing, lots of big name breakdowns, Google, Apple, Facebook, what do they call it, Baba, Bank of America, JPMorgan Chase, and ExxonMobil, all in bear markets. Worldwide stocks are also at hitting fresh lows. Not a single sector is spared, and you can't hide in utilities, as I keep saying this. We'll look at bonds, and I think they are signaling flight to safety, and also we'll look at yield curve, which is flattening, and this in the past has led to recessions. I'm looking at gold a little bit more carefully right now, and I'm seeing there's a possibility that the dollar may be reversing. Oil is still in a free fall. Natural gas is kind of in no man's land, and Bitcoin could be potentially shorted. First, let's look at S&P 500 futures. Here are the S&P 500 futures on a daily time frame. So the W pattern I'm referring to is this. Let me see, on October 16th, here is the beginning of the W. There is one part of the W, 29th of October, middle part around November, mid-November, and late November, and finally there's a completion of the W in December. So I thought we were breaking out here in the very beginning of December. Clearly that did not occur, and we see a rejection here, a strong selling here. And then we got to the bottom of this W pattern, basically around 2600 or so. And I also pointed out on the 4-hour charts there was short selling here around the red line. Maybe I'll cover it a little bit later, but I sent it to my subscribers. I was warning them to just be very, very careful. And there's the breakdown basically around 14th of December, but definitely around on the 17th of December. So this W pattern has a depth of around 7.6% or about 8%. So a normal measured move is a kind of for the same depth to be represented on the downside. So if this depth of this pattern is 7.6 or about 8%, so it would be reasonable for the move to the downside to be about the same magnitude before any kind of bounce materializes. So we can take and see where that 8% or 7.62% or whatever move, where does it end? And it's getting really close to about where the some sort of a bounce or a bottoming pattern should materialize. I'm not predicting anything, obviously, but it would make sense just based on the experience, with this type of patterns, for the bounce to kind of begin around here. And now that there is definite breakdown, and notice this lines here, this yellow, the red, the blue, and the green lines on this chart. So these lines are generated by my code, and you can find out more about it by going to MasterChartsTrading.com. But the indicator is actually programmed into this interface, and you can have the same indicator on your chart so that you can trade it just as well. The point I'm trying to make here is that basically we're in a bear market, and when we're in a bear market, a instrument that is being traded, if it's bearish in this case, we want to be trading it on the downside. In other words, I want to be placing bearish bets. I don't want to be placing bullish bets. If or when we get to 2745 currently in December 2018, then I will consider placing bullish bets. But until then, I will most likely place bearish bets. And what I want to see is I want to see a bounce, and hopefully this would be a significant bounce, which would take us, towards the red line, which is currently around 2600. You can see the red line right there where I'm hovering. It's around 2611. So if we stop falling right now, and there is a good possibility that we will stop falling, then a bounce will materialize. But that bounce would be what I would say would characterize as a dead cat bounce. In other words, it's a bounce that should be shorted. It's not a bounce that should be bought. So I'm basically waiting for that to happen. I am not doing anything. For example, here is a Dow Jones Industrial Average, collapsed. You can see collapse through the yellow lines also. The same could be said about Dow Jones. I think if we can bounce to around 2400, actually I should have said on the here that not 26 but 2400. I apologize. So here are the levels that I'll be watching around 2400 currently. That's provided that we have stopped falling. And the way I'm looking at this candle, it looks very bearish. It looks like the sellers have not stopped selling yet. So maybe we'll, stop falling, but I think the bottoming pattern needs to first unfold and then a rally materialize. But again, that rally, in my opinion, currently should be sold, should be shorted. And, if you're an investor, then perhaps a prudent thing to do would be unload your holdings on this bounce. If you are still holding any holdings, I have closed all of my positions in stocks. So you can see here S&P 500, SPY. You can see that I changed all of my retirement portfolios to 100% cash on December 17th of this year, 2018. If the bounce takes place, then we will act accordingly and perhaps look to enter on a short side. And again, if you still have some holdings, then it would make sense to unload them around, for this chart, S&P 500 ETF SPY, around 260. So the generals are fleeing, and let's look at a bunch of stocks. Google, Apple, Facebook, what do you call it? Alibaba, Bank of America, JPMorgan, and ExxonMobil. I think they're all in bear markets. So let's look at Google first. I know they call it Alphabet, but I just can't help myself, and I call it Google. So I don't trade this particular stock, so it makes no difference to me really. But what I see here is on 29th of October, right there, you can see a breakdown below the yellow indicator line. And then from here on, this basically was, what I was waiting for if I was a short seller. And following this breakdown on 29th of October, I would have considered only selling the security. Now, stocks have generally a bullish bias. In other words, they tend to go up. But if you knew nothing about securities, and all you knew that this bunch of squigglies on this chart, and right now the one squiggly close below the yellow line, and all you need to know is we want to sell it. So I would want to sell it in a bounce towards the red line, and for example I would sell it here on 31st of October. In other words, I would short it. I would place bearish bets. I would sell it again here on 8th of November, and then possibly I would sell it here, but right there on 29th of November I would have sold it too. So overall you have, for example, here you have 3 potential short trades should you so desire. And right now, with the advent of Robinhood, and the good thing is that Robinhood also allows now options trading, so you can simply buy puts. And if you know anything about options trading, you know that your downside is protected. You only will risk the amount that you're buying the option with. So if you're buying, let's say, $100 worth of put options, then that's, in case of a failure, then that's your loss. If you're selling calls, that's a different story. So let's just say you're buying puts. Here's Apple, and I am seeing the same kind of similar pattern. I see a breakdown right there on 17th of December. From here on, my mind only thinks about selling, shorting, placing bearish bet. So where would I place bearish bet on Apple? I would want to wait until it bounces to about 181, right there at the red line, and then I would consider placing bearish bets. But overall, this is a bearish security right this instant. And I would not be looking to buy it because, oh, maybe it will go up. In bearish securities, the tendency is to go down. And even though right now it's quote-unquote bargain at $150 from $230 or so a few months ago, that does not mean that it is a good bargain. It just means that the bears are in control. The short sellers, the people who are placing bearish bets, are in control of the price action. We're looking at price action pure and simple. We don't care what it is. We don't care what security this is. We don't care what instrument this is. We're looking at price action. Facebook, well, this one just collapsed basically, so let me show you my reasoning on that one. Here the collapse began in July. Here I warned against, entering any new positions on the long side. But right there on the 17th of September, you can see a breakdown below the yellow lines. Again, you can find out more about them at MasterCharts Trading about these lines. And from here on, the same thing. Let's just say I know nothing about what the security is. I only want to either unload my current holdings, or I want to sell them, or I want to place bearish bets. So for me, it was not enough of a bounce. Like ideally, I would have liked to see a close, or rather at least a touch of the red line. It's never occurred, and you can see the sellers just continued. This is called aggressive shorts. You can see I can put. So let's say you were an aggressive short seller, then you could keep selling basically around the yellow line. Excuse me. See where I'm placing the downward facing arrows. You can say that that's what we want to do. We want to keep selling it, and this is aggressive sellers, aggressive shorts. So Facebook, yeah, same thing, bearish, fresh lows, big company. I mean, this is a, let's say you had the holdings, let's say you actually held Facebook, and you did not exit here when I was saying avoid. then by now you have a even bigger loss. Now you have around 21% loss on your hand, because you can see that now we're even lower. So in this business, if your stop is triggered, if you have, basically if you enter the trade and your stop has been triggered, in other words, you cannot take the pain anymore, you have admitted to yourself that you made a mistake somehow, and the system is not 100%. You will have losses. So the trick in this business is to immediately cut your losses and stay out of the losing trades. Quickly get out of the losing trades. If you stay in your losing trades, you will have a bigger loss on your hand. So quite often you will have a bigger loss on your hand. So there's Facebook. Apple already showed Facebook. Here's Alibaba. This one also began its downward spiral earlier in August, actually, and the same thing. We just simply place bearish bets or buy puts, or outright short if you have opportunity. There's the breakdown right there where I'm hovering, 15th of August. From here on, we simply place bearish bets. This big candle I would probably not short it, but like this candle right there on 28th of August, I would have taken this trade. It would have been beautiful right there. Here's another opportunity very recently right there on the 4th of December. Same thing, same premise. We short at predetermined levels that are shown by the indicators. You can find out more about the indicators at MasterCharts Trading. Bank of America, there's the avoid signal. We were actually trading it at MasterCharts Trading, and here I said no more. I would not want to be buying this stock anymore on 23rd of October. So there are the nice opportunities. For example, here's one on the 9th of November. And there is another beautiful opportunity right there on the 3rd of December. Both would have been very profitable. JPMorgan Chase, JPM, very large company, very important company. This one we were also trading. For my taste, I want to see a bigger bounce. So you can see that the breakdown occurred right there on the 7th of December. And from then on, there was just no stopping. It just collapsed. Ideally, I want to see a bounce, and I think it is coming. So I want to see a bounce towards the red line, and it is currently at 103. And then I would want to maybe place bearish bets here. Finally, ExxonMobil. Here's XOM. What can I say? I sent an alert to my subscribers to avoid ExxonMobil on the 23rd of November. Notice a bounce afterwards. Again, a potential opportunity to sell, to place bearish bets here, to short on 7th of December. If you're an aggressive and if you know what you're doing. But notice there's a very nice gain right there afterwards. But if you did nothing, and let's say you were actually holding ExxonMobil, and then we got the, you got the alert, and you see this bounce, and you're like, oh, maybe it will go higher. So this is what I'm warning people against, is that in this business, when your stop is hit, you must exit. Don't think. So if you didn't exit here, you could potentially have an additional 9% loss on your hand, because notice how far it went afterwards. So please, please, please honor your stop and exit at the predetermined stop. Worldwide stocks are at new lows. No stock sector is spared selling. So correlations are high between stock sectors and high yield bonds and world stocks. So let me show you what I mean. So here I have on the same chart, I know it's a little busy, so bear with me. On the same chart I have graphed 5 different securities, In black we have SPY, S&P 500. This is a weekly chart, by the way. S&P 500. In this yellowish, I guess, we have the high yield bonds, and it's represented by a mutual fund called, with a ticker symbol of DHOIX. You can look it up. We also have energy, staples, and utilities. One of the three of the, well, energy is quite highly correlated, but the staples and utilities are not as highly correlated to the general market. But just visually looking at this graph, you can see that they're moving in lockstep. So in other words, stocks, again, I keep saying the same thing, the stocks move in lockstep, and you cannot hide in utilities during a bear market. Utilities also get sold. So notice the correlation coefficient spends most of its time in the positive territory. You can see above zero. For example, here is XLP, which is staples. Energy, you can see most of its time spends its correlation coefficient is in the positive territory. Utilities are probably one of the least correlated to the general market, but overall I would say that they're still better lumped together with stocks than with bonds. And of course, junk bonds, you can see, correlate quite nicely with the general market. So the same goes for various world stocks, emerging markets and European markets. It's all the same thing. It's all stocks. So for example, let's look at Europe first, VGK. And you can see that there are fresh lows. To me, this is oversold, and I would want to be looking to sell it to place bearish bets, where I would want to be placing it around the red line. Some more aggressive traders would want to short it at the yellow line, and you can see that they were very successful. Europe went into a bear market as early as 25th of June of this year, and then from then on we can just basically place bearish bets, sell it. Emerging markets, diversified emerging markets, also approaching fresh lows, so no surprise there. And same thing, you can place bearish bets around the indicator lines. And Japan, EWJ, collapsed to fresh lows today. We were actually trading it also here at MasterCharts Trading. We were looking at it on October 10th. I felt that this was basically it for the bull market for Japanese equities, and from then on I said avoid. I would not want to be buying it. If you are aggressive and you know what you're doing, you can place bearish bets, for example here at the yellow indicator lines. But overall, you can see that junk bonds and various world stocks all are moving in lockstep. And we can look at different sectors of the United States economy. So let's look first at energy, XLE. Fresh lows. Notice avoid signal was back here on 24th of October. If you didn't exit, then you can have as much as 17% loss on your hand, in addition to your original predetermined stop loss. So energy is obviously in a bear market. Industrials, XLI, fresh lows, bear market. XLB, material sector, fresh lows, obviously in a bear market. XLK, technology. Now this is a big development, and you can see that there is the close below the yellow on 17th of December, so this is a bearish security as well. And this is a very big deal because technology is an enormous sector of the United States economy, and if it is in a bear market, then I think pretty much the rest of it as well. Let me see what else. So we got industrials and very important sector, XLY, consumer discretionary. You know, you can see also a void right there on 17th of December. So not a good looking stock market posture. I mean, if you're an investor, it probably looks terrible to you. But for us, you know, for traders, we don't really care. We will buy or sell whatever looks good, and if we want to sell it, we will sell it because we have put options available and inverse ETFs available, so we can place like we were buying before. Now we can be selling. Makes no difference. So overall, again, I am thinking that we could easily. Well, a bounce will be most likely coming very soon. Here's S&P 500 again. Bounce most likely will be coming, but that bounce I think should be shorted. Okay, let me see what else here I wanted to say. And then junk debt. Okay, so let me look. Let me show you the junk debt, J and K. I've been saying the same thing since basically since February of this year, 2018. There's the breakdown on February 2nd, 2018. Here's what I like about my own indicator lines is that they are so easy to read. There's the breakdown, and then from here on we just do the opposite. We don't think about buying, we only think about selling. When or if we see a close above the blue, then we'll start thinking about buying. But right now we're thinking about selling. And you can see that there were many opportunities, perfect, just beautiful opportunities to place bearish bets. There was a couple in the February of this year, right there in April of this year, and it went to fresh lows. And then from then on, I think there was no. Oh yeah, there is another beautiful opportunity in August of this year to sell, to short. Another opportunity right there in September of this year, and the collapse afterwards. From then on, I think we see only aggressive sellers. So you can see yellow downward facing arrows. They were extremely successful and pushed the prices to fresh lows. So overall, this is not a good stance for investors. Long-term investors want to see the opposite. They want to see price appreciation, and obviously this is not happening, so the bears are currently in control. All right, let's look at Treasuries. So here's TLT, and I may have jumped the gun a little bit prematurely. Yesterday on the 20th of December, I was looking at the chart during the day, and it looked really good because I thought we were gonna close above the blue line, and I'm like, I'm gonna go and buy some. So I bought some, and literally a few hours later, boom, it went below. So right this instant, I am not 100% where this is going. So I am somewhat cautious, but I think overall, a flight to safety implies a flight towards bonds by the investors. You know, if they're S&P 500, if people are selling out of the S&P 500, people want to put their money to work, right? So where do they want the money to work? Something that's going up. What's going up? Bonds. So here's TLT. It feels like we're on the verge of a breakout. And again, I may have jumped the gun a little bit, but I'm hoping that maybe I didn't jump the gun. We'll see what happens next week. Overall, this is for bonds looking better and better, and especially it's looking better and better for short-term bonds. So let me show you what happens when interest rates become, the dynamic yield curve becomes flat. So a normal state of affairs is something of this nature. You can see that it takes next to nothing to borrow at short term for the short term, and it takes a little bit more percent, and it's a little bit higher percent to borrow at a for the longer term. This makes perfect sense, right? Now, occasionally, the yield curve becomes either flat or actually inverted. In other words, it takes the percent to borrow for a short term is actually higher than the percentage to borrow at a longer term. So a couple of such examples you can see did occur. For example, here's one that occurred in 2000, and you can see that the short-term interest rates were actually higher than the long-term interest rates. Notice what happened afterwards. The S&P 500 collapsed, and we had a relatively prolonged bear market from 2000 till about 2003. Then, again, we have a normal yield curve, and throughout this time, between 2000 and 2008, we had more or less normal behavior of the yield curve. As the closer we get to the top in 2007, you can see that we have again an inverted yield curve. In other words, it takes the percentage to borrow at shorter term actually is higher than to borrow at longer term. And again, notice what happened afterwards. We had a big collapse in 2007-2008 bear market. We are not yet there, but we're definitely approaching it. You can see that the yield curve is definitely flattening. It's not nearly as steep as it was a few years ago or a few months ago even. And this makes sense because the Federal Reserve is raising short-term interest rates. So there is the effect of this short-term interest rates rise. TLT rising implies that TYX, the longer-term interest rate, is falling, currently around 3.28%, and yeah, that's about right. So right there. So what does this mean? Perhaps the yield will drop from here even further towards 2.8, let's say, and let's say it drops towards 2.8. That's like right there, for example, and the short-term interest rates could also continue rising. So that may eventually lead towards a condition similar to what we had before 2007 and 2000 bear markets. Okay, let's continue to Forex and commodities. Here is DXY, dollar currency index. Still in a bull market. If I just look at this chart, I see nothing of concern yet. If we look at some of the individual currencies, then we can, extrapolate. But most importantly, right now, I'm looking at XAU USD, gold versus the US dollar. And right this instant, I am not seeing a lot of bearishness. Whereas here back in October, I was pretty sure that we're going to go lower and actually went lower. Right now, I don't see anything conclusive yet. In fact, I see the opposite. We're moving towards bullish levels. And bullish levels are at 1288. So if we see a breakout above those levels, then we could see a reversal in gold. And since you can see that it's XAU, gold over US dollar. In other words, gold is winning the battle, dollar is losing the battle. So by extension, if gold breaks out, I think the dollar index could be reversing. And this has important connotations for commodities, because if the dollar gets cheaper, commodities usually benefit, especially gold, obviously. So I'm kind of more cautious about Forex currently because of this situation in gold, and I want to see a resolution either way, either a breakout at above 1288 or a breakdown below 1237. Currently it's just somewhere in the middle. Let's look at oil. Here's US oil. Actually, let me look at the futures. It's easier. CL1 exclamation point. This alert was sent to subscribers. If you have held throughout this beautiful collapse, then you should have about 27% gain from November 5th alert right there. Also, aggressive traders could have sold here again in December. I don't see any bottoming yet. I think we could easily continue lower still from here. I just don't see any bottoming pattern. This is a fresh low. I keep hearing something about drilling more oil and more exports, and yeah, that would make sense. Maybe it will eventually go to like $10 and electric cars will take over. In any case, when I'm looking at this chart, I'm seeing a bearish chart and I am trading it accordingly, and we're trading it accordingly at MasterCharts Trading. Here's natural gas. These are actual alerts to my subscribers too. Alert to my subscribers. Beautiful gain here. Right now I don't have any positions, and this breakdown on 14th and 17th of December kind of worries me. So I'm looking. It could go either way. So actually, if you play options, now would be a pretty good time. If we close above $4, I think we can easily continue towards fresh highs. But if we close below 3.41 here, then I think we could collapse towards the yellow line, towards the $2.90, towards $3. So right this instant, it's kind of in between. And finally, let's finish off with Bitcoin. Here's BTC USD. Bearish security again, and I would be looking to short. And right this instant, it's about where aggressive shorts would come in. Me personally, if I was to trade this, I would wait until a bounce towards 57, 55, and then look to enter on the short side. But some people like to, trade it more aggressively. Alright, that's it for this week's recap. Please head over to MasterChartsTrading.com, click on Alerts and Indicators, and sign up for one of the trading plans. I highly recommend you actually get the indicators. They are super useful, and I'm referring to these indicators. There's 4 lines in the chart: the green, the blue, the red, and the yellow line. You can have them on your chart, and you do not need a special account. You can have a free account on TradingView. Alright, that's it for this week's recap. Again, don't forget to hit the like button and spread this video to others if you found it useful. Thanks for watching. Have another great trading week. Bye-bye.